Hi, Ed here with a favor to ask. We're in the middle of our annual donation appeal and would love it if you would consider supporting us in making the show. Energy versus climate is a labor of love. David, Sara, and I don't pay ourselves for the show because we feel strongly about the public service benefit of the project. We also don't run ads, so we can maintain 100% editorial independence. But the show still costs money to make. What little we do bring in from donors goes directly to hard production costs. You can help us to keep Energy versus Climate on the air by making a tax-deductible donation to the show today at energyversusclimate.com/donate. That's energyversusclimate.com/donate. Thanks for your support and enjoy the show. Hi, I'm Ed Whittingham, and you're listening to Energy versus Climate, the show where my co-hosts David Keith, Sara Hastings-Simon, and I debate today's climate and energy challenges, highlighting the Canadian context. Well, COP28, this year's version of the annual United Nations Climate Change Conference, starts in Dubai this week. And in what's become a perennial tradition, senior UN bureaucrats have issued dire warnings about the consequences of not getting more serious about cutting greenhouse gas emissions, particularly those from the burning of fossil fuels. Last season around this time, we introduced you to the International Energy Agency's Tim Gould, chief energy economist and co-lead of its World Energy Outlook series. We had Tim on to do a deep dive on WEO 2022. WEO 2023 was released in late October. And just last week, the IEA also released a special follow-on report specifically on the role of the oil and gas industry in a world moving to net zero emissions. It predicts that oil and gas demand will peak by the end of this decade under the policies already put in place by governments to tackle climate change. Perhaps not surprisingly, that prediction has been met with skepticism by some critics. Alberta's Premier Danielle has gone so far as to question the credibility of the IEA. So we thought it timely and useful to have Tim back on Energy versus Climate. By way of background, Tim provides strategic advice on energy economics, investment, and finance across a range of the IEA's work. Prior to joining the IEA in 2008 as a specialist on Russian and Caspian energy, Tim worked on Eastern European energy issues, primarily in Ukraine. His academic training was at Oxford University and the School of Advanced International Studies at Johns Hopkins University. He joined us from Paris a few days prior to heading to Dubai for COP28. Now on to the show. Welcome back, Tim.
Well, thanks very much indeed, Ed. I didn't realize I was your first returning guest. It's a great honor.
Well, congratulations. Yes. Very happy to have you back. So let's get down to it. Very open-ended question, Tim. What is in this new report?
Well, big question. I'll try and do it suitably, concisely. So the intention with this new work was to use the projections, the scenario projections that we have from our World Energy Outlook, and think through what net zero transitions might mean for oil and gas companies worldwide, or oil and gas producers worldwide, because we're talking about sort of state interest as well as private commercial ones. And so I think to begin that conversation, we probably need to go back to where you were just a second ago, is what do these projections look like? And as you mentioned, for the first time in our scenario work, the sort of momentum behind clean energy transitions is sufficiently strong that we see a high point reached in oil output, oil demand by the end of this decade, and likewise for natural gas. We have projected in the past a peak in coal use by the end of this decade. But if you put all of that together, you get peaks in demand for all of the fossil fuels this decade. Now, peak, I think everyone has in mind what a peak looks like. Now, this peak is fairly flat in the sense that in that scenario, something based on today's policy settings, we do see a high point, but oil and gas demand in particular remain at relatively high levels all the way through to 2050. So this is an important moment in energy history, but it's not yet that turning point that we need to be on in order to meet the goals of the Paris Agreement. There we would need to see much steeper declines post-peak and then deep reductions in oil demand because we'd be satisfying that demand for mobility or for power or for other services with increasingly with just low emission sources. Now, that's the overall context. And the question that we wanted to ask is, are the oil and gas companies going to be partners in that process of moving us beyond that peak towards outcomes consistent with the Paris Agreement? And we went through all sorts of, to us, interesting areas in which the oil and gas industry could contribute to that process of change. For the moment, we came to the conclusion, looking at the record on capital flows and everything else, was that for most companies, they are, at the margins of that process. They're looking on while clean energy transitions gather pace. Because when we add up all of the money that's going into a range of clean energy technologies and infrastructure, that this year, in our view, is around 1.8 trillion US dollars. Only 1% of that is coming from oil and gas companies.
Got you. So I want to quote your executive director, Fatih Birol, who says in the foreword to the report that if governments deliver in full on their national energy and climate pledges, and even more so if they manage to shift the world onto the narrow pathway to limiting global warming to 1.5 degrees Celsius, the consequences for the oil and gas industry will be profound. So maybe you could talk about some of those consequences, but a question is, if we're talking not so much a peak and decline, but a peak and a long plateau followed by decline, why are those consequences profound?
So, the scenario in which we don't have a steep decline is one that's based on today's policy settings. That's one that's consistent with around a 2.4 degrees Celsius increase in global average temperatures by the end of this century. So at the moment, we are already seeing some quite extreme events, weather events associated with a rise of 1.2 degrees Celsius. So that scenario is one that leads to very severe impacts from climate change. So double what we've seen up until now. And what we ask is, if we do get on track for those climate goals, then, is the oil and gas industry going to be with that momentum behind change or not? Now, I have to say that, when in your introduction, you were describing the IEA's scenario work in, that this was somehow controversial or an outlier in the world of scenarios. I don't believe that's the case. I mean, you can look at many, many different scenarios for global oil demand, including ones from leading oil and gas companies. The idea that we might see at least a flattening in oil demand by the end of this decade is not particularly controversial. If you look at our projections, they're very close to those in a sort of baseline scenario to those of ExxonMobil. BP and Shell have even steeper declines than we do. So I think the idea that the IEA is somehow out there with this initial projection, I don't think it stands up to the scrutiny that you get if you look at all of the other scenarios out there.
So agreed, Tim. So if I could just interrupt, the projected peak, that peak has been around for a while now, but in the past, when we unpack those models, it kind of looked like modelers really had to twist the dials and make fairly optimistic assumptions around the deployment of government policy and the shift from people out of internal combustion engines into electric vehicles. But are you suggesting that that isn't the case this time?
Well, I think it's pretty broadly accepted that for road transport demand, which is the biggest single component of oil demand, almost half, you're quite likely to see that going into decline by the end of this decade. And in fact, in order for that not to happen, you need to take some pretty pessimistic assumptions about what happens to the electrification of the global car fleet. Or you'd need to be thinking that there's going to be such a large expansion in the global car fleet that you wouldn't see, that electrification, in a sense, is just not affecting the trends as much as it does in our work. I mean, but the sorts of structural changes that we're talking about are already visible. So, in 2020, when you started your energy and climate podcast, around the world, 1 in every 25 cars sold was electric. This year, it's going to be closer to 1 in 5. And then, by 2030, in our view, there's sufficient momentum already to get us close to 1 in 2. And there's buses going electric quite rapidly. There's a very large fleet now already of 2 and 3 wheelers that are already also moving. So we're not talking about something that is speculation in future years. We're talking about trends that you can already see today.
Yeah, no, I'll add to that. We had Amy Myers-Jaffe on Energy versus Climate. I think it was our second season, talking about the electrification of transportation. She, of course, has come out with that interesting book on the digitization and the impacts on energy. And I heard her speaking recently. And so we're seeing now demand for gasoline in the US peaking and declining, which isn't surprising given that the US has moved so aggressively with the Inflation Reduction Act and other measures. But we're actually seeing now China's gasoline demand peak. I think it's Sinopec was projecting a demand peak. You're projecting a demand peak, which I found was really surprising. I did not expect that in China.
Well, China's a really interesting one. And it's in fact crucial to the dynamics that we are describing. And because I think everyone's used to the idea that China's driving all sorts of trends in global oil, gas, and coal markets. And indeed, that's been the case. So 2/3 of the growth in global oil demand over the last decade has come from China. 1/3 of the growth in global gas demand has come from China. Pretty much everything happening in coal markets is happening one way or another because of what's happening in China. But I think that period of very heavy infrastructure-led, energy-intensive growth in China is coming to an end. I mean, China's built out its infrastructure so far and so fast, and that there's relatively few places you can put those volumes of steel and cement and everything else. So China is also changing, and it's a huge investor in clean energy as well. Almost half the new solar and wind deployed around the world is deployed in China. Well over half, something like 60% of the electric car sales in the world happen in China. So that means that driving force for some of the fossil fuel trends that we've seen in recent years is not going to be the same as it was. And we don't yet see that an India or an Indonesia is going to have the same weight in the global energy system to replace that role that occupied by China. And that helps to explain why we see different dynamics in the future than we've had up until now.
Great. I'd like to bring David and Sara in because it seems that at least in some quarters of the oil and gas industry, they're either not seeing the same structural changes or more likely they're just interpreting them differently. And I think, and David, you'd share this, an International Energy Forum S&P Global Commodities Insights report suggested that oil and gas upstream expenditures increased by close to 40% in 2022 to just under $500 billion. I had a look at that report. Climate change and peak oil were not even afterthoughts in them. And then I think of the consolidation in the oil and gas industry, Chevron buying Hess for close to $60 billion, Exxon buying Pioneer Natural Resources for close to $60 billion. And having been on the edges of the World Petroleum Congress, generally the consensus there was what I'd call the conventional consensus, the orthodoxy in many parts of the oil and gas industry, and that oil demand will keep rising as global economies and populations grow, and especially in the developing economies. So, David, Sara, I'm not sure who wants to weigh in first, but what's going on in the oil and gas industry?
All right, I'll grab it, but I'm sure not an expert. None of us are really. I think part of this, though, is not so much dispute about the fact that it's flattening and might peak this decade, but dispute about what happens after that, different views about that. So I think, everything Tim just said about the pace of change, especially in liquid fuel vehicles because of electrics, I buy. And my guess is most sentient people who are in oil and gas companies buy that too. I think the question is what happens after that. So I think it's actually extremely unlikely the world is actually on a 1.5 compliant pathway. And I'm not even sure that would be ethical at this stage, given the kind of costs it would impose. And I think the question is how quickly the decline is after. And my sense is there might be lots of people in the oil and gas industry who would agree there's a peak about this decade, but see a kind of slow decline after that. I want to put in one more thing, which is maybe I'm mistaking this, Tim, but you made it sound like something kind of strange or unexpected or wrong that the oil and gas industry is only putting about 1% of the investment into clean energy. I think mostly they're not structured to be effective in clean energy. I think what's going to happen is those companies, oil and gas companies, will gradually die as the need for their product dies. And I don't think many of them will do the kind of swords to plowshares pivot, the green tech pivot, where they sort of move because they're just energy companies to be green energy companies. I think we've seen again and again that there's structural reasons why that's not true. We shouldn't expect it to be true, and there's no problem with it.
I think that's a great point, and it's one that we discussed a lot as we were putting this together. And we are not trying to be prescriptive about the path that oil and gas companies should take. It's a legitimate choice in net zero transitions for an oil and gas company to say, well, actually, oil and gas is what I do. This is my specialization, and for as long as there is demand for this, I will continue to produce. And as transitions work their way through, I will return cash to shareholders and gradually wind down my operations. But then what we're arguing is that if that's your choice, then the only way that you can be compliant or with a 1.5 degree scenario is to say, well, actually, I'm no longer going to invest in new fields, and I'm going to do everything I can to make sure that the oil and gas I bring to market has as low emissions intensity as possible. Now, there are other options, of course. There are other options for national oil companies and for private companies. And what we try and argue in the analysis is that there's a suite of technologies which have some affinity with the skills of oil and gas companies. Offshore wind, expertise in dealing with harsh offshore conditions, experience in handling liquids and gases, so liquid biofuels, gaseous biofuels, hydrogen-related fuels, and then, of course, the CCUS, which I'm sure we'll come to. That is not a negligible part of a net zero emission system. So when we reach net zero emissions in 2050 in one of our scenarios, those technologies which we judge to be adjacent to areas of oil and gas company expertise, that's 30% of the final consumption. So there's an opportunity there. And that's the argument that we're making, is that for companies that don't want to follow the route that you outlined as they sort of wind down their business, there are things that they could know how to do and know how to do profitably that are worth taking a look at.
Two things, and then I want to give it over to Sara. But so one is, of course, there's a whole bunch of this technological skills that are in the oil and gas and adjacent companies. Because a lot of those skills are not actually in the integrated companies; they're in the EPCs and sort of related companies in a technological kind of ecosystem. So for sure, lots of those skills are relevant to energy transition, hydrogen or wind turbines, just as you said. But I think what we've seen, and I think we'll likely continue seeing, is those businesses are not likely very effective embedded into the core of an oil company business. And I've seen that back to the late 90s. I used to interact with some senior people at BP, Paul Rudder and so on, and they tried to do this, but the kinds of business structures they had set up to succeed in oil and gas just didn't have them succeeding in say, renewable electricity. And I don't think that goes away. So I think lots of the people and lots of the skills in EPCMs and so on migrate out to other things. And maybe some of the oil companies really transition, but I think it's actually very hard for them as business entities to transition. I don't think it's that they're going to say, we're happy to get smaller. That's not mostly what companies do. But I think it's going to be hard for them to actually make that transition. But I want to hammer again on the 1.5 point. I don't think, so I said at the beginning, I think most sane people, even running oil and gas companies, would agree that we're seeing a flattening of demand, that it might peak this decade. My sense is almost nobody thinks the world is anything like on track for 1.5. And I think if you look around, not at what governments say, but what governments are actually doing, you don't see any evidence governments are on track for that. I think we made huge progress, but getting to 1.5 emissions cuts alone is a different order.
So I don't disagree. Sorry, Sara, I just want to respond on that. But I mean, we recognize that 1.5 degree stabilization is a huge lift. We are not on track for it. Even if you add up all of the national energy and climate pledges, that gets us down to about a 1.7 degree stabilization. There's still an awful long way to go beyond that for a 1.5. I mean, we have these scenarios in the analysis. I mean, we use them to make points about the challenges that are faced by countries, companies, people, communities in net zero transitions. I mean, none of them should be considered a forecast, but they help to illustrate the trade-offs, the choices that are in play.
So couple of thoughts from my side, and I mean, maybe I'll anchor it in the 1.5 discussion, right? I do think that there is a gap in the acknowledgement of the pace of electrification of transportation, and starting with passenger vehicles and moving on to buses, right? I think, I don't know, somebody should do the polling and go ask people in downtown Calgary, what they think the rate of EV car sales is. But I do see parallels, and I've been thinking about this in terms of, I think that, again, China is the big sort of, I don't want to say unknown, but like the big thing that people are maybe somewhat unaware of, right? In terms of both the pace of electrification of vehicles in China, but actually I think also importantly, the pace of growth of China's EV manufacturing capacity, which is like essentially, I'm going to say something, I don't know if it's totally true. I mean, I don't think you can buy a Chinese EV in Canada. Maybe you can buy one of those, the one brand that they collaborate with someone else. But essentially, to first order, there are no Chinese EVs in Canada. And that's really not reflective of what's going on around the world, certainly, across Asia, but also increasingly actually in the EU as well, right? And there's this big divergence between the way that China is playing in the North American auto manufacturing market versus the EU auto manufacturing market for probably all kinds of, different reasons underneath that. But I think what that leads to is that people in North America are increasingly convinced that, we're just not going to be able to make enough EVs to meet all this demand. And they're missing half the world's, EV manufacturing capacity, maybe not dissimilar to, what happened in the, I guess, 80s around the growth of the Japanese vehicle, export market, which really, I think it's fair to say, took at least big chunks of North America by surprise. And so that, I think, is really relevant for the oil and gas story in Canada. And the conversations that at least I'm a part of still seem relatively anchored in this like slow pace of transition. And then what follows from that is really sort of thinking about the changes more as tweaks to the sort of current case versus how actually disruptive things could be. If you start to get into, we often also hear, well, we have all this refinery capacity and it needs our heavy oil. And so there's, we're going to compete because the only other heavy oil producer that we're competing against is Venezuela and so forth, which, certainly is true at the margins. But again, if you start to imagine a world where that gasoline demand shrinks quickly and much faster than some of the other products that are coming from that barrel of oil in a refinery, then you're in a world where you start to need to be doing, pretty significant retrofits or significant changes to your refinery, at which point then, you can look around, the refiners are going to look around and say, well, what's the mix that I want to design my refinery around as an input? And that is not a conversation that I'm hearing at all in Alberta. And it's those kinds of things that I think, take your point, David, that, I also think we're probably not going to make it to the 1.5 degree target, but I don't think that means that we're not going to see some of these more substantial changes. And I think that, again, you look at what the oil and gas companies in Canada are doing the first half of 2023, Pembina in their waiting to launch reports found that they sent 75% of their, cash flow back to shareholders, through buybacks and dividends. And this seems very aligned with exactly that, sense that things are shrinking. And Kate McKenzie had this really interesting article in Heat Map, kind of saying how some of these things, like even consolidations, are not necessarily contrary to the idea that oil companies are planning for more of a decline. You would imagine that you see some of this consolidation. Again, this is not, that this is happening overnight, but these trends really seem to be pointing all in a similar direction.
Yeah, and I'd like to bring us back to some of the orthodoxy and then turn back to you, Tim, with a question in the report. But I will say, I saw Sara on a panel recently at the Canadian Climate Institute with Chris Severson Baker, the executive director of the Pembina Institute, and Mark Cameron, who is a VP with Pathways Alliance, which you might know is a group of producers that have come together and have made a net zero commitment. And the question that the moderator, Dan Wicklum, who is the head of the Transition Accelerator, used to run COSIA, the Canadian Oil Sands Innovation Alliance, asked Mark, because Mark was saying he's rattling around his Tim Cup, as the Pathways are doing. They've got a proposal for $16.5 billion to help them reduce their emissions by 22 million tons per year by 2030. Half of that will come from CCUS, as Tim said, you will talk about later. But that price tag is $16.5 billion. And then Dan asked, how much in 2022 did your company send back in free cash returns as buybacks and dividends? And the answer was 29 billion. Now, but the orthodoxy that I want to talk about is that many producers, well, I'll go back to your report, Tim. You said many producers say that they will be the ones to keep producing through transitions and beyond, and they cannot all be right. And I would say, of course they can't all be right, because everyone knows that Alberta will provide the last barrel ever produced, because that's what politicians and industry leaders consistently tell us. Maybe you can comment on that, and you can comment on the 4 dimensions that your report outlines that could really factor in who is going to win that competition, if you can call it as such, to provide the last barrel ever consumed in the world.
Actually, one thing that occurred to me when Sara was speaking was around this investment question, because it's indeed true that oil and gas investment has picked up over the last couple of years. But it's one of the very few bits of the global investment picture that remains below 2019 levels. So we haven't yet got back to pre-COVID levels of spending on oil and gas supply. And I think that also speaks to some of the hesitation that there is out there, particularly when it comes to big capital-intensive, long lead time projects, and because of all of the elements that we've discussed. So onto your question, Ed, if you take governments at their word and say they will hit their net zero targets, for Canada, for China, for India, for the EU, for many other countries around the world, then, by mid-century, oil and gas demand would be nearly half what they are today. And if you get that 1.5 degree stabilization, then it's more like 75% reduction from today. So we don't go to zero. We still use oil and gas in all of our scenarios in mid-century, even in a net zero emission system, because a lot of that, as Sara was pointing out, increasingly, we're using that for petchems, for which kind of still remain hydrocarbon dependent in our scenarios, but that's a non-combustion source non-combustion use of oil and gas. And so the question naturally arises, as that demand scales back, then who produces? And one of the things that's very noticeable in our own work is that as that demand scales back, you run into some quite profound questions about the distributional impacts, the energy security impacts, and everything else of that scaling back. And we illustrate that with the cases that Ed was talking about, because you could see all of this just from a cost perspective and say, well, look, it's global market, lowest cost wins. But if you look at it only in those terms, then you do get a big concentration amongst the large resource holders today, particularly in the Middle East. And even though the size of the pie is shrinking, there is a reluctance in many countries to contemplate having more than half of global supply coming from a relatively small group of resource holders. So you could think about it in different terms. You could think about it in terms of emissions intensity. So in a transition, shouldn't we be prioritizing in a sense, the cleaner or the oil and gas that's produced with the most regard for emissions intensities? Now, Canada has a story. Canada is acting more coherently and consistently on those upstream emissions than most other countries around the world. The issue is that some of the Canadian production, notably the production in Alberta, just takes a lot of energy to get out of the ground. So it's irreducibly, emissions intensive in that respect. But even today, the numbers that we have suggest that Canada's production is a lot less emissions intensive than you would imagine based on energy alone. So the fact that Canada is acting on methane actually already produces a dividend in terms of its ranking on the emissions intensity side. You could also look at these decisions through an energy security lens and say, well, actually, I would prefer if, as an importer or as a country, I would like to rely more on my domestic production than on imported production from, maybe countries that are not necessarily geopolitical allies. You could even look at it through an equity perspective and saying, well, actually, shouldn't we have some sort of system that weights global production in transitions towards countries that need the revenue for their national development? So countries with very low incomes per capita. So there's all these different ideas floating around about how you might think about the allocation of supply in transition. But the bottom line is that there is a smaller amount of oil to be produced. And, in that kind of world, it's not necessarily the great business to be in. If you're producing extra oil in a scenario that doesn't necessarily need it, then are you going to be receiving a reasonable return on that investment? Because one of these striking findings of our net zero emissions by 2050 scenario is that the declines in oil and gas would need to be sufficiently steep that we don't need any new fields. Indeed, some existing production would need to be shut in. And so you're looking at, in all likelihood, the prospect of volatility, but you're also looking at some reasonably low prices in such a scenario, at least for extended periods of time. So it's not obvious that how you would attach additional value to any of those qualities that I outlined before. So I guess there's a long way around to saying that this gets very complicated, and it's probably going to be some combination of cost and emissions intensity. Cost is not necessarily Canada's friend in that regard. It's relatively high cost resources, at least for oil. Emissions intensity is a good story, better than you'd imagine for Canada, but it's not clear who is attaching value to those lower emissions at the moment.
I'm going to channel my inner David Keith here and think geopolitically. Maybe it would be a good thing if the Middle East producers are the last producers standing, as they often have the most volatile geopolitics to contend with, and some of them even have nukes. Now, I'm not asking you to comment on that, Tim, but Sara, I know you want to jump in on energy security.
Yeah, I mean, I just found these sort of 4 dimensions really interesting to broaden. I think we often talk specifically about the cost and emissions. We talk a little bit about the security preference, but what stood out to me was that the results in the modeling for the security preference case were very different from the way that I think I often hear it talked about in Canada, which is, the security preference case is one in which Canada wins because, in our mind, we are a trustworthy, secure partner and granted, we are in various dimensions. But in fact, if you look at as I'm assuming, what drives these results, if you look at the countries that are actually going to be importing a lot more oil and gas, they are countries like China and India that would then, through their security lens, perhaps not choose Canada, which is what I think the results are showing there. And that, our sort of typical trading partners that we think of like, the EU and others, would actually be the ones that are moving more quickly to reduce their demand. And so, their sort of security lens is less important than China's. And that I think is it stood out to me, I guess, just because of how different it was from the conversation that I hear around security from a Canadian perspective, and a good reminder that one's own security looks different from someone else's. And similar for the low income preference case. Again, there, I think we often hear this argument of Canada has to export a lot of oil and gas to help all of the low income countries around the world. But again, if you look at, another way of legitimately, helping people would be to say, well, we should allow those countries to produce their oil and gas and get the wealth directly from that. And we should be producing less. So again, it's sort of just a very different results that I think come from a similar starting point of questions.
I think Canadians do kind of have this, Canadian oil patch has this kind of security mindset that imagines things will be good. I think it's almost meaningless self-talk. I think that the underlying realities are, in a world where oil production is declining, which it certainly is going to, we can dispute how quickly it's going to decline, then the winners are the ones in general. I think economics has a pretty profound role where we have cheap production, and Canada just doesn't have cheap production. As you say, a bunch of the importers won't see Canada as a super secure supply. So I find it very hard to see that the Canadian oil patch does well in that world. I do want to come back to, maybe it doesn't matter, but I think it does. Should we take countries at their word about net zero? I think the answer is certainly not. We understand the political dynamics of why countries say these things. There are reasons why it makes sense to make claims politically to satisfy some constituents, where those claims put costs on future generations which you don't yourself expect to actually meet. And I think any reasonable objective look at what the world is actually doing, what major governments are doing, I think would suggest the governments are not, in a systematic way, aiming at net zero by 2050. In some ways, it's so far away, it doesn't really matter anyway. What is happening, which is fantastic, is far more action on cutting emissions than was happening a few years ago, and a sense of rapid technological change with solar and EVs suddenly getting cheaper, a sense that it's possible to really cut emissions. But the idea that countries are in a serious, coordinated way, actually planning in a way that goes through the whole government to actually aim at 1.5, I just don't see that objectively. And let me say it even more sharply. I'm not sure 1.5 would be an ethical target at this point, because you have to cut so quickly that it has big harms. And remember, there's nothing scientific about 1.5.
Tim, I want to move us to a different part of the report. And that is, in the report, you sort of paint the picture of what a major or a super major oil and gas producer would look like in a net zero scenario in 2050. And some of the things that they have to do, and falling into kind of a couple big buckets. One is driving down emissions from their own operations, and the other is investing in clean energy. And we've unpacked the investing in clean energy and how paltry that sum is right now. And David's point that maybe they're not the best to do it anyway. But maybe you could talk a little bit about, well, what would they be selling? What would their production portfolio look like if they were really moving toward a net zero scenario by 2050?
So I think if I can just stop for a second on the agenda that we're setting out for oil and gas companies, because indeed we've talked about diversification into clean energy and the potential limits to that and the opportunities there. But I think one non-negotiable element for any company wishing to align with the aims of the Paris Agreement is to reduce its own emissions. And those are ridiculously large worldwide. In our estimate, there's over 5.1 gigatons of CO2 equivalent coming from just the process of getting oil and gas out of the ground and to consumers. And just for context, that's around the size of the total energy-related greenhouse gas emissions from the United States. So this is a very substantial contribution to climate change, and there's a lot to be done there. And I think Canada, in that sense, is doing a lot already, and is one of the countries that is looking actively at how it can align some of those policies with a net zero emission scenario. So we talk about the need for a 75% reduction in methane emissions by 2030. That's very much where Canadian thinking is at. So, and then moving on to what those companies look like in 2050. Again, we don't want to be prescriptive about the direction that these companies might follow. But there are a number of different models that we discuss in the analysis. I mean, clearly one of them is the model being followed by some of the European majors, where they diversify into new areas like electricity generation and go into the route of becoming your energy provider. And so whatever you need for mobility or for heat or for any other service, that will be the company that you turn to. But we also look at what that profile of the production would look like if a company chooses to be a provider of liquids or a provider of gases. And there, you can produce, and we illustrate what it would take for them to provide roughly the same, quantity of energy services that they do today, but in a low emissions environment. And then that gets us back into the technologies that we've discussed already, liquid, gaseous, bioenergy, hydrogen-rich fuels, and the application of CCUS in many cases.
Yeah, and I'm struck when I look at the graph that you have, and I know it's just an example, but the share of renewable electricity, and I raised that because, and I've mentioned it on this pod before, Ben Van Beurden, when he was running Shell, I remember telling myself and a few colleagues, like, it's really hard to turn petrochemical engineers into electricity and renewable electricity engineers. That's a tough transition. I see it's tough enough when your portfolio is largely coal, which fortunately the world is moving away from, or at least Canada and Alberta pretty aggressively, and combined cycle natural gas, to then develop a significant renewable electricity portfolio. We've seen that tried, and more often than not, it tends to fail. But before we turn to questions, maybe Sara, David, you want to jump in? And then Sara, I'd love to turn to you about Canada's oil and gas emissions cap and how that may or may not be a driver of some of these changes that Tim is talking about.
Just to jump in and repeat for a second, it's not really about the engineers transitioning jobs. Actually, there's enormous room for engineers to move jobs and for engineering big firms to move jobs. The issue is the business structure you need to be successful in electricity is in general not the kind of business structure you need to be successful in oil and gas. And to the extent that they are in the same company, there's no reason why that company should do better. There's a reason why we are moving away from big conglomerates and lots of things. So I think it's not about what the engineers can do. It's about what is the real business case for conglomeration of different business units that is a business structure, don't have much to do with each other.
And I'd add to that, David, it's the expectations of the investors in the capital.
Yeah.
Because if you've gotten drunk off of high, 40% ROI returns from oil and gas projects, and then you're told on the solar project, there's sub 10, but it's stabilized cash flow, but it's going to take 30 years. Exactly. That requires a very different patience of capital that typically doesn't exist in those companies. But Sara, turning to you. So the oil and gas cap. Good driver, bad driver, realistic, unrealistic. You were speaking on that panel I mentioned, the Canadian Climate Institute, on that cap. So I'm giving you the floor.
Yeah, I mean, I think very important driver, right? And here's where I admit that I didn't do the homework I had intended to do, which was take the chart on page 145 of this report that kind of says what the scope 1 and 2 emissions reduction target has to be, at least in the IEA's eyes, in order to be aligned with a net zero scenario. Maybe some homework for any of our listeners who are working on the oil and gas cap, but I think that would directly translate into, what is that cap need to be, and there's a lot of debate about that, right? And I mean, on that panel, I think everybody said, oh, sure, we can have a cap. It's just, what is the cap? And that's where it matters. Obviously, if the cap is at where emissions are today, it's very different than if the cap is at a 45 or 60% reduction by 2030. And so I think the cap is actually critically important to both, or either, test whether companies are really aligned with a net zero scenario, and or to get them aligned such that if we're going to spend public money on this, it's going to be at least justifiable. So I think that's I've often said the challenge is how do you set that cap in the right way. And so I think that this that the modeling that that the IEA has done is a really interesting data point to add into if we want to claim in Canada that our oil and gas companies are on track to be aligned with a net zero emission scenario, we have some metrics here to compare those two. And at least by eye, it looks like that is close to the cap that the federal government is proposing.
Yeah, maybe I can say a few things on that, because clearly the modeling that we've done is for a industry-wide reduction in emissions, in its emissions from its own operations. And we find that a 60% reduction in emissions is consistent with that net zero emissions by 2050 scenario. And the reduction in emissions intensity is slightly lower than that. And you can translate that into the world of other scenarios. But it seems to us that this is something that makes sense, whichever scenario you're in. Now, clearly you can't just translate percentage reductions across different jurisdictions or different types of company, just because some may have much more scope to cut than others. Some, and you don't want to penalize people who moved first. But I think, the way the analysis is set up, it helps to provide some guidance for policy as to where the direction of travel. And I think in that sense, the way that the Canadian government has taken on things like a 75% reduction in methane emissions suggests that these kind of benchmarks can actually be quite helpful in providing an impetus for those discussions.
Yeah, I heard Canada's Environment and Climate Change Minister Stephen Guilbeault speaking at that same conference where Sara spoke, and he said that was one of the things that he is most feeling ambitious about, and at the top of his priority list is that methane reduction, which is encouraging given its importance. Let's get to questions. So we've got our first question from Jason Switzer, who is known to many of us here on EVC. Jason recently became the head of Equitable Origin, which is an NGO that works with businesses and communities and governments on sustainable development of energy and natural resources. So shout out to Jay. Jay's question: we tend to focus on oil, but the discussion on market share of natural gas is a lot fuzzier. I'd like to better understand where natural gas fits in your view, how methane abatement and technologies like net power and CCUS fit in that world, and how we might navigate the challenge of higher inflation. Tim, do you want to take the first crack?
Yeah, I'd be happy to. So, I think it's a very, very good question, just because the dynamics for natural gas are somewhat different. I think there's two interesting things. First is that, the last 10 years have been very good for natural gas demand. It's risen in a way that we had modeled in a high case for natural gas back in 2011, or even a golden age, as we called it, of natural gas. But that sentiment has shifted quite substantially. And so we believe that golden age was really in the last decade, and now we're in a different world. And there's a number of reasons for that, but one of them is that the reputation of gas, this sense that it's an affordable, reliable source of imported energy for price-sensitive developing economies, particularly in Asia, that's taken a significant hit over the last couple of years because of those price spikes, the market turbulence that we've seen. So we have brought down our outlook for natural gas quite substantially over the last couple of editions of the World Energy Outlook, and that's what leads us to this flattening that we have in our stated policy scenario. So in our view, there's a couple of things that help us understand the role of gas. One is, to what extent is it going to be demonstrably better for the climate than more polluting sources like oil and coal? So it's about the transparency on the emissions intensities. And then the second thing is really a story about whether India, countries in Southeast Asia, and elsewhere in South Asia, some other parts of the world, whether they really build natural gas into their development strategies. Because there's a whole wave of new LNG coming to market in the second half of this decade. Mostly from the US and Qatar, but of course also from Canada. And I have to be honest that we struggled to find a home for all that gas, even in a stated policy scenario. I think there is this assumption that, if gas is cheap, you will use it, but you need infrastructure. You need countries that really haven't invested heavily in gas to say, yes, we're going to go for that. And I've been traveling in India, talked to Indian policymakers, likewise in Southeast Asia. There is some of that, But if China doesn't develop in the way that the gas industry hopes, I think there is a big question mark about where that demand for natural gas to come from. So that implies oversupply and perhaps some difficult circumstances for at least some of the people involved in the natural gas export value chain.
That is a really interesting answer, and it really interesting. And it obviously one possible answer that Jason alluded to is, does natural gas with CCS become important for electricity? And for me, big question mark. Obviously, we need to manage variability of intermittent renewables, but natural gas with CCS can do that, but it's not necessarily that great at doing because it has relatively high capex. So it's really interesting how it'll play out. I mean, the big prize, of course, is switching coal to gas in India, but I've also been in India recently, and I don't get a sense that that's going to happen fast.
I've actually done the analysis with some co-authors. We looked at the distance of coal plants in India to existing natural gas pipelines, right? Because that is a big constraint on coal to gas switching. And what we find is that India is particularly poorly placed to see a lot of coal to gas switching, that a lot of their coal plants are actually located quite far from natural gas pipelines. China, slightly, bit better, not all plants, but there is more potential there. But the coal to gas transition in India, at least repurposing the capital in the way we've seen happen, arguably quite successfully here in Canada and across the US, is much harder because of just that lack of pipelines. And then by the time you have to invest all that money in building out those pipelines, you start to look at a broader set of options.
Yeah, I from the conversations I had with the majors and the super majors in the mid 2010s, I always had the sense that they are overestimating the demand for natural gas that would materialize now that we're into the 2020s. And partly, I think, is because they seem to underestimate the cost declines that we would see in renewable electricity. Which then, just before we move on to our next question, Tim, kind of back to you. Then we had the Ukraine war, and European countries were hoovering up, gas reserves and buying everything that Qatar had to offer. What's your sense now that, we're a year and a half in and a year and a half away from people talking about this resurgence of natural gas and resurgence of LNG export and import terminals because of the war in Europe? What has actually played out since? And sorry, this wasn't on the script or in the outline, and I'm kind of hopefully not catching you blind.
No. I'm happy to talk about that. So in a European perspective, there has been new investment in LNG regasification terminals. And so one thing that's happened over the last couple of years is that, Russia used to account for roughly 35% of European gas demand. Now that's well below 10%. And LNG has gone the other direction, around 10% up to 30-something%. So you've just had that swap effect, but you've swapped also long-term contracts with Russia for gas, for pipeline gas, to a reliance on LNG. And Europe hasn't contracted that much of that on a long-term basis. It's really relying on the spot market for a lot of that gas. It's going to portfolio players like your Shells and Total Energies and various traders and so on. Now, indeed, there is an accusation of hypocrisy leveled at Europe for going around and the world and saying that, you have to invest only in clean. And then when the crisis hits, looking for additional gas. But I think, the balance the adjustment that took place after the global energy crisis, it wasn't really about additional coal. In our view, additional coal took about 5% of the strain caused by Russia's cuts, and it wasn't even really about gas supply, although there was huge competition for those resources. The burden of adjustment fell on the demand side. We've seen very significant reductions in European gas demand. Some of it weather-related, some of it structural, some of it just demand destruction from European industries producing less. And so that's really where the big adjustment has taken place. Now, when you look at it from the perspective of a South Asian importer, that's contributed is feeling like well, we thought we had a claim on that LNG, and then European buyers came in and bought it all. And that's contributed to this idea that, well, actually, we don't feel that it's something that we can count on. And I think that is going to take a while that reputational damage, in a way, is going to take a while to unwind.
Got you. Okay, we're going to bring in another live questioner, kind of our go-to questioner on EVC shows, Robert Tremblay. Rob, go ahead.
Okay, so this question is just about how we should expect peak demand and declining demand to impact prices. So how should we expect peak demand to impact the prices of oil, coal, and gas? I think a popular conception is that lowering demand will lead to lower prices, but I think we could also imagine maybe lower expectations of demand lead to underinvestment and higher prices. So like, which do we expect? Maybe a combination of both, and then extending that, how do we expect whatever our price expectations are to impact climate policy and the narratives that surround declining demand and the resulting climate policy?
Yeah, Tim,
it's a lot
first crack.
Yeah, so that's a excellent question, and because in theory, if you look at the investment requirement going from a slightly increased market to a slightly declining market, I mean, the actual amount of investment you need doesn't change dramatically, because most of the investment that is required in oil, gas markets is just going to replace the natural decline in today's fields, rather than accommodating changes at the margin on the demand side. However, I think it is true that sort of declining markets are harder to read, and you are likely to see people, the chances of misreading market, I think, increase. So I think the baseline expectation should be for cycles of under and over investment. Our model is one that seeks equilibrium. So the prices that we have there are the equilibrium prices that result from a smooth process of change. But I don't think a smooth process of change should be anyone's baseline as we go through energy transition.
Yeah, very well said.
And I think that, thinking about how that plays out for climate policy and energy policy in general, reflecting back over the last period now where we've seen high levels of inflation in Canada, like in, much of the rest of the world, a lot of that inflation, or a big chunk of that inflation, has been driven by rising energy prices, rising energy costs. And so I think there is, certainly when prices and completely agree that, I think we're going to see a lot more volatility in prices than we've seen before through this transition. You have also mentioned in the report, obviously, the fact that you may have certain market participants actually trying to grab more market share and being willing to take lower prices in exchange for that. But I think that volatility is maybe going to be, in my mind, one of the biggest drivers of, what happens at a consumer level, rather than prices being, certain specifically low or specifically high. And I think that does tend to drive towards quicker action to protect consumers and individuals from volatility through reducing exposure to these prices, right? And in so much as, at least that's how the U.S. has, sold their climate policy under the Inflation Reduction Act, right? And that was a specific choice to sort of frame this as, if we reduce use of oil and gas, we're reducing exposure to inflation. So I think, if anything, that kind of volatility is not going to slow energy transition. If anything, it may, lead to kind of faster, at least efforts. If I'm a government that's trying to protect my consumers from inflation, that's probably one of the best ways that I can do that, is to get them onto more, domestic and lower carbon sources.
Yeah, can I just add one data point to that?
Yeah, go ahead, Tim.
Because we were adding up all of the additional expenditure that governments around the world, in a sense, were forced to make to shield consumers from the effects of higher prices during the last couple of years. It's $900 billion. That's an awful lot of money. And so if volatility is your baseline expectation, and you think, well, actually, I may be on the hook for these kinds of emergency payments down the road, then I think that creates a powerful incentive to act early to insulate consumers against the effect of those kinds of shocks. Which speaks to the rationale then for investing in efficiency, moving faster on electrification and everything else.
Completely agree about volatility accelerating transition. I think what we didn't talk about enough this session was the geopolitics. The fact that, while in Canada or the US, if the oil industry goes down very fast, there will be a bunch of hardship for sure in Alberta, but these are economies that are pretty diverse and big, and we can tolerate it. I think the thing that we didn't talk enough about is really Russia and the Middle East. Hugely unstable regions that are hugely dependent on petroleum and oil and gas exports. And in a world where those decline quickly, it couples to political instability in ways that can be quite frightening, and I think will play a big role in the way the transition plays out that we didn't really talk about.
Yeah, and I know you have a colleague or an old colleague at Harvard, David Megan O'Sullivan, that maybe we can bring on the show to have exactly that conversation.
Yeah.
Yep. And maybe we'll get someone from the government of Canada to talk about protecting consumers by suspending the carbon tax on home heating oil, which that's a whole separate conversation and probably not in keeping with the thesis that you outlined, Sara, of how things should work in an era of price volatility. But folks, I'm afraid we've hit the top of the hour, a little past. We have to wrap it up. So first off, thank you so much, Tim, for making yourself available again to share your thoughts and IEA's reporting on energy versus climate. We're all grateful.
Thanks so much, Ed. Thanks very much, everyone.
We'll be back on December 5th with special guest and sci-fi author Kim Stanley Robinson for what should be another fascinating conversation. Thanks, and see you then. Thanks for listening to Energy versus Climate. The show is created by David Keith, Sara Hastings-Simon, and me, Ed Whittingham, and produced by Eva Voinigescu, with help from Crystal Hickey, Serena Gibson, and Talia Granau. Our title and show music is The Wind-Up by Brian Lips. This season of Energy versus Climate is produced with support from the University of Calgary's Office of the Vice President Research and the university's Global Research Initiative. Further support comes from the Trottier Family Foundation, the North Family Foundation, and our generous listeners. Sign up for updates and exclusive webinar access at energyversusclimate.com. and review and rate us on your favorite podcast platform. This helps new listeners to find the show. We'll be back on December 5th for one last live webinar in 2023, and it's got a very special guest, sci-fi author Kim Stanley Robinson. You won't want to miss our conversation with him about his first cli-fi book, Ministry for the Future. A pod version of the show will be available shortly afterward. See you then.